Welcome to the Southwest Vermont Chamber of Commerce Expert Power Hour. Sit back, relax, and learn from the experts.
Hello, welcome everybody. My name is Erica Floriani. I'm membership manager here at the Southwestern Vermont Chamber of Commerce. To my right is Mr. Matt Harrington, our executive director, and we want to welcome you to our first of 2025 Expert Power Hour. Today's Power Hour is Financial Literacy, a beginner's guide to investments, and we are very excited to have Carolee Kennedy from Merrill Lynch. She's a financial advisor, senior portfolio advisor. Come in and join us and speak to us about membership or about investments and how she can help you. So with that, Carolee, if you are ready, we'd love to have you kick us off.
Absolutely. So, like Erica just said, my name is Carolee Kennedy, a senior portfolio advisor at Merrill Lynch. And this is just one of endless resources we have for educational material. So hope to share some more in the future. I'm going to go ahead and share my screen. Now. Okay. Can everybody see that?
Yes.
Awesome. All right. So this is a beginner's guide to investing. We like to start any educational series off with the basics. So this is going to get us a well-rounded idea of how to construct a portfolio. And then, at the end, we'll have some time for Q&A. You can ask me any questions that are more specific to you, whether it's small business questions, personal finance questions, etc. All right. So before we get started, I do have some disclosures. The first is, I know we're not selling investment products here, but especially because it is on Zoom, I want to make sure to get disclosures out of the way. So investment products sold by Bank of America are not guaranteed by the bank, not FDIC insured, and may lose value. And I will leave this up for just a second so that anybody can read the details. All right. So when it comes to investing, nothing will pay off more than educating yourself. When you invest, there's no guarantee that you'll achieve the investment returns you might be hoping for. But understanding some basics about investing and how to make smart, informed investment decisions could be important to your financial success. Here's what we'll cover in the presentation. First, we'll review some reasons why we invest. We'll explain how to understand different investment choices. We'll discuss managing investments. We'll review 401k plans and why they're important to long-term goals. And we'll discuss some key actions to consider. So why invest? Let's look at 4 simple reasons. First, investing can help our assets keep up with inflation. That's a big word in today's economy. As prices rise over time, you could be paying much more for something 20 years from now than you are today. Second, we should prepare for what could be a long-term retirement. 1 out of 3 males and 1 out of 2 females who are in their 50s today will live to 90 years old. No one wants to outlive their retirement savings, but nearly 1/3 of all households nearing retirement have no retirement savings at all. Third, we'll want to maintain our standard of living in retirement. To do so, depending on our retirement goals and lifestyle, we may need approximately 85% to 90% of our pre-retirement after-tax income for each year you'll be retired. So the reason it's 85 to 90% is because a lot of retirement assets, Roth distributions, those are already taxed. So you're not going to pay taxes there. Also, certain expenses go away. You're not commuting to and from work. Life tends to be a little bit less expensive. However, in the first few years, people like to spend a lot in retirement. They like to, travel and do all those things. To maintain that standard of living, depending on our retirement goals and lifestyle. Oh, I already read that part. I'm sorry, guys. Investing through an employer's 401k plan can help us work towards that goal. So investing now for our retirement years can be a smart decision. And with investing, we have the potential to benefit from compounding, which is a big key word. Sorry, I'm reading on a very little screen and took a bunch of notes so that I wouldn't get nervous and skip things. Let's see. All right. Keep in mind, however, that investing involves risk, including the possible loss of principal value invested. So we're going to go more into that in a minute, because obviously there are risks to investing. And so the way that you allocate your investments and reallocate those, rebalance those is gonna be a big defining factor in how we can, save ourselves from some of that risk. Let's see. Trying to skip to the next slide. Okay, compounding can be a powerful thing. Compounding is when you earn a return not only on the money you invest, but also on the potential returns you may get from your investments. The sooner you start investing through your 401k plan, the more you contribute, the more time you have to benefit from that potential. And with a 401k plan, your account has the potential to grow on a tax-deferred basis. The hypothetical example here, let me scroll down, is for illustrative purposes only. It assumes a salary of $60,000, contribution rates of 4% and 8% with contributions made at the beginning of the month, and a 6% annual effective rate of return. Now, an effective rate of return is an interesting thing. So it speaks to compounding. So if you're putting in, say, 6% a year, but you're earning, say 4% on that money, the next year you're going to have your 6% contributions plus that 4% that you already earned. So your money is going to grow faster the longer that you're investing. Now let's review the investments typically available through a 401k plan. And I recognize that some of you may not have 401k plans, small business owners. There are other options there. And if you're one of those folks, I'll share my contact at the end of this so you can reach out and we can discuss different retirement plans for small business owners. There are three main factors that might help you understand your investor profile and influence you to invest. So there is a QR code you can see on the screen. It's going to give you a little quiz and help you decide on what your risk appetite is. I think it's a really, really cool tool. It takes about 30 seconds to do the quiz. So anybody who wants to go ahead and take that picture, you can go ahead and get started. To start, let's think about the goals that we have. I'm sorry, you'll see people coming in and out because my desk is right by the stairs. Let's see. So some goals. Educate your children, retire early, buy a vacation home. Why does time horizon matter? Generally, the more time until you need your money, the more time you have to ride out market downturn. So for instance, if you came to me and said, I have X amount of dollars, we would actually divvy that up into separate accounts. So say, this is for your retirement goal. This is a long-term time horizon. Here's a pile of money for a short-term goal, buying a home, buying a car, and you're going to be more aggressive with those long-term assets. The reason being, exactly like I just read, is that you have time to ride out market downturns. We wouldn't want to put you into something aggressive for money that you need to get your hands on in, say, 2 years. Because if you happen to be in a market downturn when you need to access that money, then you're realizing a loss. And so we really want your most aggressive portfolio to be the longest time horizon. All right, risk and potential returns. Stocks, bonds, and cash equivalents, so cash equivalents would be like money markets, are the three main asset classes. Each has a different level of risk and potential return. And understanding some basics about each asset class can help you choose a mix of investments that make sense for you. Stocks represent ownership in a company. They generally offer the highest potential for return, but also the highest risk. Stock funds will fluctuate in value, are not guaranteed, and have been more volatile than other asset classes. Bonds are essentially loans to a company or a government body that promises to repay the loan, usually with interest. These debt securities generally offer modest potential for return and moderate risk. With bond funds, returns of principal are not guaranteed. Bond funds have the same interest rate, inflation, and credit risks associated with the fund's underlying bond. So when we talk about a fund, we're talking about like a mutual fund or an ETF, which is basically, if you can picture a pie chart, it's a basket of goods. So a bunch of investments put into that pie, and then they take slices and they sell it. Let's see, bond funds have the same interest rate. Yep, I said that already. Generally, the value of a bond fund rises when prevailing interest rates fall and falls when interest rates rise. So if any of you were invested in CDs, say around, end of 22 into 23, when interest rates were really high, and those CDs you had bought years prior, you probably saw the value of those CDs fall. And that's because now we're issuing higher yielding CDs. And so you'll see that fluctuation with fixed income securities. However, if you're buying individual bonds or buying individual CDs, the method is to just not sell it until it's matured, so that you get that principal back. If you sell ahead of time, you could lose some of that principal. Cash equivalents are short-term debt securities. Their potential return is generally low, as is their risk. Any guarantee by the U.S. government, its agencies, or instrumentalities applies only to the payment of principal and interest on the guaranteed security and does not guarantee the yield or value of that security. How can you invest in these asset classes? The easiest way is through mutual funds or similar types of investments, such as the ones offered to you by a company's retirement plan. So we just talked about mutual funds. Usually a 401k was going to have certain mutual funds that you can buy into. Usually it's an age-based fund by default, but you can often go in and change those if you're a more seasoned investor. Mutual funds can help simplify investing. They pool money from many investors and invest towards a specific objective. They're managed by investment professionals who choose the individual stocks and bonds included in a fund. They generally invest in many different stocks or bonds based on the objective, so you get exposure to all the investments the manager has selected. That's why a mutual fund helps spread out your money over different investments. But in some cases, in most cases, you'll want more diversity than a single fund can provide. So again, a fund has an objective. So if it's a growth fund, it's going to have you in mostly large cap growth stocks. So you don't want to say, okay, I have one mutual fund, I'm covered, because it's only covering that one sector. Spreading your assets across different asset classes can help you balance investment risk with potential return. It can also help smooth out ups and downs in your portfolio's performance. The reason is simple. Economic or market conditions that cause one type of investment to decline in value may cause another to rise. Oh, sorry about that road noise out there. Spreading your assets across different investments is called diversification. In addition to diversifying across asset classes, consider diversifying within asset classes. For example, consider several different types of stock funds for your allocation to stocks rather than a single fund that might invest in only one type of stock. Diversification and asset allocation cannot ensure a profit or protect against loss, but it can be an effective way to help manage investment risk. So again, if you have multiple different funds, then you're going to have sprinkled in all kinds of investments. And if one, has a really, really bad day or a really bad year, some of the other ones in there are going to kind of pick up that slack and help, manage your risk. All right. Okay, so your plan will likely offer both actively and passive managed funds. Actively managed funds seek to outperform a benchmark index. Managers make investment decisions and they generally charge a higher investment fee. So there we're talking about mutual funds are actively managed. Passively managed funds seek to match a benchmark index. Managers make decisions to best match or track an index, and they generally charge a lower investment fee than funds with similar objectives. So that's going to be like an ETF, less expensive, but they're not going to change the investments due to market conditions. It has that one objective, but you end up saving a little bit on the internal expenses. What's a benchmark index? It's a market index against which a fund's performance is compared. A large cap fund, for example, might be a benchmark against the index of large cap stocks, such as the S&P 500 index. Funds are benchmarked against an index that represents the type of securities that they invest in. Before I keep going, does anybody have any questions so that I don't run over your needs? Okay. When you invest, you'll want to weigh the potential returns of an investment with its potential risk. Generally, the higher the potential return, the higher the risk of loss. The opposite is generally also true. The lower the potential return, the lower the risk of loss. So for example, a bond has a much lower risk of loss than a stock does, but your return is going to be based on the market rates, and you're not going to make quite as much money, but you're going to have that safety factor. For example, cash equivalents on the left side have the lowest risk, along with the lowest potential return. On the right, with the highest risk and the highest potential return, are international stocks. Understanding how to balance risk and return is a key concept. You want your investments to grow in value, but there's always a risk and a worry that your investments may lose value. And there's also a risk that if you play it too safe, invest too conservatively, your investments won't grow enough to help you meet your retirement income goals or keep up with inflation. That's why, I went too fast. That's why balancing risk and return is key to investing. Looking again at our slide, compare large cap equity funds, second from the left on the bottom, with small cap equity funds at the top right. Large cap funds typically invest in larger, more well-established companies. Small cap funds typically invest in smaller, less well-established companies. Small cap funds have a higher potential return than large cap stocks, but that higher potential is accompanied by more risk. So for instance, large cap is, a lot of those big tech companies. You see those on the S&P 500. There's definitely risk there. However, those are tried and true companies. They've been around for a while. We look at things like balance sheets to make sure that they have good financial health. With a small cap company, it's newer, not as well established. And so it's got the potential to grow, exponentially. However, it also carries risk that it might not work out. Let's talk a little bit about managing your investment. An investor without investment objective is like a traveler without a destination. And that is so true. There's another saying that I hear all the time, and it's like a dream without a plan. It's just a wish. And it's so true. You need to educate yourself on these things, and you have to have an objective. What does my retirement lifestyle look like? How much money do I need a year to cover my bills and live comfortably? And then you make your allocation based on those goals. When choosing your investment mix, understand how asset allocation and diversification can differ. The portfolios shown on the screen illustrate that difference. With asset allocation, you're dividing your assets among stocks, bonds, and cash equivalents. You could choose one stock fund, one fixed income fund, and one money market fund. That's portfolio A on the screen there on your left, with 45% allocated to a single stock fund. So that might not look like a risky allocation, but having only one stock fund, that is actually pretty risky. You haven't spread out your investments across enough sectors to really hedge that risk. Let's see. With diversification, you're going further and spreading your assets across different investment styles, market capitalizations, and geographic regions with a single asset class. That's portfolio B on the screen, with 15% allocated to each of the 3 stock funds. Asset allocation and diversification do not ensure a profit or protect against loss, but they may help you manage risk and may help provide for less volatile returns. That's because a decrease in the value of one investment could potentially be offset by an increase in value in another. Once you've selected your investment mix, you'll want to check in on your account somewhat regularly to see how your investments are performing. So I know in our industry, we have a minimum of an annual review. We usually check in with clients much more often than that, but at least one annual review to look at the objective, look at the goal, revisit your risk tolerance. Oftentimes with age, as you're approaching things like retirement, you'll become more conservative because you go from wanting to grow the money to wanting to conserve the money. So it's really important to be checking in on your investments. Is your allocation or mix of investments still about what you want to be? If changes in the markets have thrown your allocation out of line, you can rebalance to get back the original mix. For example, assume you choose to invest 50% of your account in stocks, 35% in bonds, and 15% in cash equivalents. The allocation shown on the left side again. But if stocks perform much better than bonds for a year or so, you could end up having 60% invested in stocks, as shown on the right. With more in stocks and less in bonds, your account may now have more risk than you intended. In that case, you might want to rebalance. That happens all the time. So you have a really good year in your stock portfolio, and now that allocation has superseded what it was supposed to be, say, that 60% or whatever. And so then you want to rebalance. And that can be tricky. There's a lot of psychology that goes into investing, because if you have a really good year and all your stocks are up, the last thing you want to do is sell out of those. But sometimes you may end up selling out of those to reallocate back to the bond side or the cash equivalent side, just to make sure that that mix is still stable. There are several ways that you could do this. Direct more of your contributions to the investments that have lagged. Consider another investment option in the trailing asset class for new contributions, or you could shift some of your current balances in the investments that have outperformed to the lagging investments. That may not be an easy decision, but it could help position you for possible upturns in that investment class or category. You may be reluctant to rebalance if you're pleased with how your account has performed, but there was a reason you chose a particular mix in the first place, and the investments that have done well or poorly may reverse course in the future. There we go. As you invest, you'll likely encounter periods of market volatility. If history is any guide, there'll always be periods of extended market weakness or extended market strength, like we're seeing now. So don't overreact to every headline or short-term fluctuations. Don't let them distract you from your long-term goals. You can't avoid market ups and downs, but you can rebalance regularly to help make sure that your investment plan stays on track. Even with extended periods of volatility, markets have recovered in the past, although, of course, past performance does not guarantee future results. When you think about it, once your investments have lost value, getting out of the market and selling them may have the effect of locking in those losses. If you stay the course, there's a chance for market recovery. During periods of market turbulence, or any time really, it's important to keep your financial goals in mind. You may want to come up with different strategies for different types of goals and consider how a market decline could affect your ability to pursue those goals. So that again goes back to what I was saying originally, where, if you have the goal of retirement, which we all do, but you also have a goal of buying a house or paying off a mortgage, we may actually want you to set up different accounts for those goals so that they can be allocated appropriately and given the correct level of risk. Understanding inflation. Every period has a unique set of risks that can dramatically impact our financial lives. The most powerful tools you have to help support financial success, however, are staying disciplined and being prepared to take advantage of opportunities as they arise. Let's discuss one of the risks in greater detail: inflationary risk. A pretty big buzzword over the last couple of years. While investors have enjoyed an unprecedented 40-year sustained period of relatively low inflation, historically averaging about 2.6%, the potential for sustained periods of higher inflation, like the present, are inevitable. It's important to remember that during an entire decade, from the mid-70s to the mid-80s, inflation stayed above 5% and peaked at 14%. Let's discuss some adjustments to hedge against rising rates and stay ahead of inflation. So does anybody remember when to buy a house, it was like an 11% interest rate or a 14% interest rate back in the 80s? I don't, but I've heard about it. So what we've gone through the last couple of years is not new. Inflation is something that happens in our economy and will continue to happen. So we need to be prepared for those ups and downs. If you're approaching retirement, there are some extra considerations you'll want to consider to protect against. This includes avoiding overspending during the first few years of retirement. I know we're all excited to go on vacation. Giving the newfound sense of freedom that comes with retirement, it can be tempting to want to splurge on a number of large purchases and fun trips. Of course, you want to enjoy your wealth while you're healthy and active. Just try to remember that those assets may need to last decades or longer. So don't overdo it and try to stick with a budget. This is specifically important given the sequence of risk returns that you face as a new retiree. Your portfolio returns in the first few years of retirement, when you begin taking distributions, are critically important. That's why I said oftentimes as you approach retirement, we will tone down the risk because we want to focus on keeping those assets. Any significant losses you experience during those years can dramatically impact your portfolio's ability to recover and generate sustainable income later on. A smart withdrawal strategy, like quarterly, monthly, one that adjusts for changes in the market and provides a floor of predictable income to cover essential expenses no matter what the market does, can dampen the impact of volatility and help you generate the kind of lifetime income you'll need to fund all of your retirement years. And finally, don't ignore the potential for higher inflation over those years. While the inflation rate historically averages about 2.6%, a sudden increase could erode the purchasing power of your retirement income. It's important to stay invested to help your retirement savings grow enough to deliver income streams in the future that have the potential to outpace inflation. So again, when we talk about inflation, usually things like bonds and money markets, those are never going to outpace inflation. They're going to be on par with the current rate. So having some risk assets, some stocks in there that could outperform inflation, that's really going to help balance out your returns. Here are some steps to consider to help you stay nimble during inflationary periods. First, know that inflation is normal and it can be helpful to stay focused on your goals. It's also a good time to revisit your budget. What spending leaks could you shore up? An emergency fund can help you deal with unexpected expenses. One of the first things we do when we talk to a new client is we make sure that they have an emergency fund. We say 3 to 6 months, but we really like to have a 6-month fund, savings that covers all of your cash flow needs, so all of your expenses. Reason being is that we don't have to, if there's an emergency or you get hurt at work or you're out a paycheck for a couple of months, we don't want you to have to call and say, hey, I need you to take some out of my retirement account. If you're under retirement age, there's a penalty to that. If we're in a down market, you're realizing those losses. So there's a lot of reasons why it's really important to focus on your emergency fund first. It's also, finally consider conducting a retirement checkup, making sure your investments still align with your overall goals. So again, say you're 65 and we have you in a moderate portfolio and, you come to me and say, do you think that this is too risky? Well, what kind of other assets do you have? We'll do all kinds of statistical analysis to try to gauge how long into retirement those funds will last. But you may consider going down in risk tolerance and going to more like a moderate conservative just to preserve those assets that you've accumulated. Now let's discuss your 401k plan. So again, I know some of you are small business owners. 401k plan might not be something that you use. There are other plans that you can use, especially for small business owners. And my contact will be available for you if that's something you want to discuss further. Your 401k plan can be one of the best ways to pursue long-term financial goals. So what is a 401k? A 401k plan is a retirement plan sponsored by an employer. 401ks offer potential tax advantages to participants, and you contribute through convenient payroll deductions. So some of those tax advantages are money that you contribute into your 401k is you're not paying taxes in the year that you contribute. So it'll lessen that tax burden each year. What's another interesting factor is when you are taking distributions, when you are retired and you start taking from that 401k plan, you're going to be taxed on those distributions, but it's going to be at your current tax rate. What's good about that is your tax rate goes down in retirement because you're no longer making income. So you end up paying less taxes than you would if you use those money prior to retirement. A 401k plan also offers the potential for compounded growth. So you can earn a return not only on the contributions you make, but also on any earnings on those contributions. So as we mentioned earlier, the sooner you start, the more time you have to benefit from the potential for compounded growth. So I need to read this quick disclosure. Investing involves risk, including the possible loss of principal. Investments in foreign securities or sector funds, including technology or real estate stocks, are subject to substantial volatility due to adverse political, economic, or other developments, and may carry additional risks resulting from a lack of industry diversification. Funds that invest in smaller mid-cap capitalization companies experience a greater degree of market volatility than those of large capitalization stocks and are riskier investments. Bonds funds have the same interest rate, inflation, and credit risk associated with the underlying bonds owned by the fund. Generally, the value of funds rise when prevailing interest rates fall and fall when interest rates rise. Investing in lower grade debt securities or junk bonds may be subject to greater market fluctuation and risk of loss of income and principal than securities with higher rated categories. There are ongoing fees and expenses associated with investing. Bear in mind that a higher return potential is accompanied by a higher risk. So I just want to note one thing that people may not know about. So a junk bond compared to a bond, an average bond that an investor would buy, it's got a low credit rating, meaning the company hasn't proven their credit worthiness, very much like our own credit score. So oftentimes, if they are issuing debt securities, basically they need a loan from a consumer, they're going to offer a higher yield than investment grade debt securities. That higher yield, again, is associated with higher risk, and that risk is credit risk. All right. There are different types of tax-advantaged accounts that may help you prepare for retirement, such as an employer's 401k plan and individual retirement accounts. Everybody, I'm sure, has heard of IRAs. There's a couple different kinds that you can use, pre-tax, post-tax, and we can get into that later if you have follow-up questions. Each type is different, and you'll want to understand those differences. No matter which type of account or accounts you have, try to make sure you're contributing enough to work towards your goals. Consider increasing your contributions on a regular basis if you can. Even 1% per year may add up over time thanks to compounding. Most companies, if you do have a 401k, it allows you to go in and change that contribution rate. I know for myself, I put myself on a yearly schedule where it increases automatically. You don't really notice it happening because 1% isn't astronomical, but it does make a big difference. If you participate in an employer's 401k plan and they offer you a company match, try to contribute enough to get the full company match. So for instance, if your company offers a 3% match, you want to make sure that you're putting at least that much in so that you're getting all of that free money. There's no reason to leave free money on the table. Love free money. If you are age 50 or older, consider making catch-up contributions to your IRA or 401k if you can. For instance, a traditional IRA allows for a $1,000 per year catch-up contribution for people 50 years old or older. So it's a nice benefit to help really further that investment savings. So this is mostly about our website. So if you are a Merrill client, this is going to be relevant to you. Small businesses, we offer 401ks to small businesses. So it gives your employees access to this benefits online website. So the Benefit Online website is the easiest way to enroll your employer's 401k plan, manage your account, and review your investments. If you are enrolled, review your investments to make sure your account is invested the way you'd like. You may need to rebalance. You'll also want to decide who would receive the money in your 401k account in the event of your death. So designate your beneficiary or check your current designations. That's really important, folks. Whether it's a bank account, a retirement account, it's very, very important. I know we are all superheroes and nobody is thinking about an untimely death, but as we know, it does happen. And it becomes a really complicated process if you don't have beneficiaries designated on the account. If you do have beneficiaries designated on the account, you forego probate, and that money goes directly to your beneficiaries. So I always like to remind people, think about what your family members would be going through in the event that something happened to you. It's the last thing you want to do is set them up to have to, go through probate and all of that. You can also save paper and clutter by signing up for e-delivery and plan information. You can choose to receive personalized financial education. To get started, select profile settings at the top of the Benefits Online screen, then select email preferences. So this is another QR code I recommend everybody scan. It's going to bring you to the Merrill Lynch website where it has all kinds of educational material. There's webinars, there's like a podcast, so all kinds of information. I know one of the hardest things to do is ask what you don't know in terms of finance. A lot of people don't know the ins and outs of Social Security, 401ks, retirement planning, etc. And we all feel like we should know that stuff. So this is a private way that you can go on. You can click on the resources that you need and get that information. So the Event Center is your resource for educational resources that can help build your financial future. Through the center, you can sign up to attend one of many live interactive educational series, listen to Building Financial Momentum audio casts on a variety of topics, and access a library of on-demand videos. Through Merrill, you also have access to a variety of resources that can help you improve your financial health. Access the Events Center at the website there on the left, and you can sign up for special events, join weekly webinars, listen to recorded seminars, and more. When it comes to your money, a little knowledge can go a long way. Visit bettermoneyhabits.com, choose a topic, and start exploring. What's really cool about Better Money Habits is it's all free resources. They also have resources for children. So getting financial literacy conversations started with kids at a young age is very important, and this gives you some resources to help you do that. And the Benefits Online Education Center at education.moutlook.com offers a resource that can help you make smart, informed financial decisions. So that is it for my presentation. I'm going to go ahead and take off the share screen so that you can see my face. And does anybody have any questions? I apologize for stumbling in the beginning. Public speaking doesn't get easier.
Carolee, I just want to say thank you. I know there is a lot of information that you are trying to get out to us in this Power Hour. And the fact that you have so many resources available that people can go to after this to explore on their own, because a lot of times we've witnessed when we do these type of Power Hours that a lot of people just really don't want to talk about their finances in front of other people. So are there any questions that we have for Carolee? We could do those now. We're going to check on Facebook as well, but thank you for doing this. I know that I started investing a little too late, and so I'll be doing the catch up that you spoke of, and just talking about how it's not as scary if you can take it in these bite-sized pieces. And that's what I really hope that our members see, especially our younger members who are just starting in work or have that first real big job. Mm-hmm. If you can invest at the beginning in yourself, little pieces that you don't even miss, like you said, 1% that you do the annual increase, it's really important to invest in your future by investing. So I appreciate you sharing all that information with us.
Yes, of course. And anybody that has questions that they don't want to say out loud, is there a chat that I can share my email in, or?
Yes.
Yeah. Yep. And you can also say it out loud, Carolee, too. That'll just help the people like online on Facebook, but there should be a chat that you can put it in. And also we can share that with our members too. We'll send some information out after.
Okay, yes.
The only other thing that was added in the chat that I see was Beth Walsh just referencing the Vermont Saves program as well, which we had Treasurer Mike Pichek on late last year.
Yes,
and I know Vermont's on rolling out kind of I think a progressive concept to help more people save more often, and I know that's part of the state's initiative. So you can learn more about Vermont Saves as well. We can get information about that out.
Awesome. And you are exactly right. Small increments, start early. That's the most important thing. I know I talk to a lot of kids at the local high school, and I push, open a retirement account, and their perception of time is, so short that they're like, retirement. But you can use those accounts for other qualified expenses like first-time home buyer purchases and things like that. So there's all kinds of nuances in the financial world that can help people really be successful.
Great. Well, not seeing any other questions, we're going to wrap this up. I want to thank you for joining us online, in person. We do have a roundtable in person happening next month, March 6th, on workforce. Rob Bainey with Southwest Vermont Tech will be on hand to discuss that with us, and that's happening bright and early, 8 a.m. At Angry Eggs 2 on Main Street here in Bennington. So hopefully you can join us for that. And is there anything else we should be adding?
No, I think that this has been a great overview, and I think it's a great way to kick off the year with some financial literacy. So again, thank you, Merrill Lynch, and thank you, Carolee, and thank you everybody for joining us. Stay warm, stay safe,
Thank you, CAC TV as
Yes.
well. Mike Cutler over there helping us with all the technical ends of it. We appreciate it. All right. Have a great afternoon, everyone.
Thank you.